In the UK, you're given a wide range of perfectly legitimate tax allowances and investment wrappers that can significantly improve your long-term wealth if you know how to use them properly. So today, I'm going to show you how to build a modern 2025 ready tax efficient wealth strategy using the UK rules that actually matter. I'm Tony Byrne of Tony Talks Money. I'm a chartered financial planner and have been for almost 20 years. And I have 40 years experience as a business owner, a fund manager, financial planner, and real estate investor. This video is purely educational. I'll walk you through the allowances, reliefs, and structures available in the UK system as of the latest budget, which was only yesterday. These aren't loopholes, they're openly published rules designed to help people plan responsibly for the future. Let's get into it. Understanding today's tax landscape. The UK tax system has changed a lot recently, especially after the 2025 budget yesterday. Before you plan anything, it's crucial to know the landscape you're planning with. Income tax thresholds are frozen until 2031, so there'll be yet another 6 years where your tax allowances are not going to increase with inflation. So that naturally brings a lot more people into higher rate of tax. This is known as fiscal drag. Dividend tax, as well as tax on other forms of investment income, is going to rise by 2 percentage points. And with dividend tax, it's going to apply from April 2026, which means if you're a basic rate taxpayer, you'll pay 10.75% on dividends. If you're a high rate taxpayer, you'll pay 35.75%. And if you're the top rate taxpayer, additional rate taxpayer, it's called, you'll pay 40.35%. Remember, this is on money that's already been taxed, that you've invested. Savings and property income tax rates are going to rise a year later from April 2027. So the basic rate of tax on savings and rental income will go to 22% for the basic rate taxpayer from 20%. High rate taxpayer will pay 42% instead of 40%, and an additional rate taxpayer will pay 47% rather than 45%. Now, there is a great planning tool called salary sacrifice, where you give up some of your salary to pay straight into a pension by your employer instead. Savings in national insurance, that you won't be able to do that if you're paying more than £2,000 a year into your pension. Your salary sacrifice in more than £2,000 a year from April 2029. So there's still a stay of execution. Overall ISA limit of £20,000 per annum per person still remains. As cash ISA limit may reduce to as little as £12,000 a year. But cash ISAs, remember, are just bank investments that just earn you interest, whereas a stocks and shares ISA can give you potentially capital growth as well as dividend income. So planning matters now more than ever. The rules are tightening, thresholds are frozen, and tax on income producing investments is rising. ISAs, your tax-free foundation. The ISA, or individual savings account, remains the simplest and most valuable tax wrapper available to UK investors. Currently, the annual ISA allowance remains £20,000 per adult. So all growth or capital growth on your stocks and shares ISA, all dividends and all withdrawals from your ISA remain tax-free. And there is no capital gains tax to pay in ISAs. So no dividend tax, no capital gains tax, no income tax. As mentioned earlier, cash ISA sub-allowance may reduce from 2027 from £20,000 to £12,000. So long-term investors, in my opinion, should prioritise stocks and shares ISAs. Let me give you an example based on 2025 numbers. So if you were to invest £500 a month at a rate of return of 7% a year for 20 years, this would come to £262,000. It's a lot of money, isn't it? And any money you take out, any withdrawals are tax-free. ISAs are not glamorous, but they're predictable, flexible, and extremely tax efficient. Salary sacrifice. It's designed by HMRC, which is our tax people in the UK, and widely encouraged by employers. What you basically do is you give up part of your salary. Your employer pays that money into your pension instead. Your employer doesn't have to pay 15% employer's national insurance. And you yourself will save national insurance of anywhere between 2 and 8%, depending on what you're paying. Many employers will add national insurance saved into your pension. From April 2029, the national insurance saving element will apply only to the first £2,000 per annum. Income tax relief will still apply in full. So let's use as an example, £1,000 salary sacrifice. This would cost a higher rate taxpayer approximately £580 net of tax. That's how much they would have received net of tax. The employer will pay £1,000, becoming £1,150 if they add back the national insurance they've saved. Company directors, how to optimise legally and transparently the money you invest. This is based on my e-booklet, 97 Money Gems. So for business owners, the government gives several legitimate tools to structure income efficiently. A good way of doing this typically is for the business owner to take a modest salary, often around the national insurance threshold, and then pay dividends after taking the small salary. Maximise your employer pension contribution, which is currently £60,000 a year. Now, the contributions technically must be wholly and exclusively for the business, but in my experience, I've never come across a case where HMRC has refused to allow tax relief on pension contributions for business owners and for their staff. So that shouldn't be a problem. Now, the pension contributions paid by the company, by your employer, or by the director's own business, they are eligible for tax relief against corporation tax, which is currently 25% for most companies, apart from smaller companies or small profit companies. You still pay 19%. The pension contributions that you make, they count towards this annual allowance, which is £60,000. In other words, there's a cap on how much you can pay into a pension. But if you miss the last 3 years of pension contribution, or some of the last 3 years of pension contribution, you can carry forward the amounts you've missed. We'll come on to explain that a bit more in detail in a moment. Why does this matter after the budget yesterday in November 2025? Because dividend tax is going to rise in 2026. This makes pensions even more attractive as a long-term planning tool. Employer pension contributions remain one of the cleanest, most transparent, and most government-supported planning methods for directors. Capital gains tax allowances. The CGT allowance is now only £3,000 per annum. It was not long ago almost £12,000. It's not a huge saving, but it's still valuable. It means you can make capital gains on things like shares or investment property, and the first £3,000 is tax-free. So one thing you might do with your share portfolio, you might decide to crystallise some gains up to £3,000 each tax year, so it's tax-free. Or you might decide to transfer your shares into an ISA, which is tax-free. So that can be a tool. It's called Bed and ISA. Yeah, so it'd be tax-free going forward once you transferred it. What you can also do, if you're married, spouses can transfer assets between them, and there's no capital gains tax to pay on that gift between spouses. The spouse that receives the shares does inherit the capital gains tax record of the spouse who gifted the shares, but you're just deferring the tax indefinitely. But if you use each other's allowances, if you're using husband and wife, they're transferring the shares between them, that means they've effectively got £6,000 worth of allowances, £3,000 each. That can still work. It's small, but using it consistently helps protect you from unnecessary capital gains tax. Pension carry forward, the big one. Now, what is this? First of all, this rule still catches people by surprise. Basically, you can pay in up to £60,000 a year into a personal pension. Now, if you are a very high earner, and off the top of my head, I think you have to earn something like $240,000 a year before the £60,000 allowance gets tapered down. So above a certain limit, for every £2 you earn, the allowance gets reduced by £1 until it goes down to £10,000. So some very high earners, £250,000 or more, may only be able to pay £10,000 a year into a pension. So just bear that in mind. But the carry forward rule allows you to bring forward any unused pension allowances for the last 3 tax years. So let's say you have a pension scheme, but you haven't paid into it for a few years. Then if you've missed out the last 3 tax years of paying into that pension, then you got up to £180,000 you can carry forward. And in the current year, you can pay in your £60,000 allowance too. But there's a catch. In order to get tax relief on that £240,000, you have to earn at least £250,000, because without that, you won't get tax relief on the pension contribution. So you've got the allowance you can bring forward, but you've got to have the earnings in that year to get the tax relief. And why does this matter post-budget from yesterday? Because the salary sacrifice national insurance boost from employers shrinks from 2029. Larger pension contributions may be better made as employer contributions, and the employer can be your own business, of course, or your own personal pension contributions with tax relief. So the carry forward rule is extremely useful for individuals, especially those ones who have fluctuating earnings or late career contributions. That can be helpful there. Property investors, borrowing versus selling. What's all this about? Since 2020, the tax relief on mortgage interest for landlords has been limited to 20%. It used to be tax relief up to your highest rate of tax on mortgage interest as a tax deduction. Now it's limited to 20%. And from 2027, rental income or property income tax rates are going to rise by 2%, whatever category of tax whatever level of tax you're paying. But if you refinance your property by releasing capital, or they call it equity release, you don't trigger capital gains tax, because if you borrow money against your property and pass the money to you, well, there's no tax to pay because borrowing isn't subject to tax. Whereas if you sell the property, then you pay capital gains tax on an investment property. So in this case, affordability, risk, and stress testing are crucial. For property investors, the next few years reward careful structuring. You must evaluate net yield, or the net return, after the 2027 tax changes, not just your gross rental income, which means your income before tax. Many investors use refinancing to access capital very tax efficiently, but the numbers must work, the risk must be acceptable, and advice is absolutely essential. So run your numbers and sense check it. Pensions for estate planning. Personal pensions have been free of inheritance tax for as long as I can remember, until it was announced last year that Labour will bring pensions into the inheritance tax net. From April 2027, personal pensions will be subject to inheritance tax. So that is a bit of a blow. For now, they're still free of inheritance tax. There is a small chance that the government could do a U-turn on it. I very much doubt it, but you never know in this world. The government has made a number of U-turns in recent months. This could be one of them, but I very much doubt it. There's an outside chance. So your pension can be passed on to your beneficiaries, like your children, for example. They can inherit your pension. If you leave your pension to your spouse, it's still free of inheritance tax on the first death. If you die before 75, the withdrawals from your pension are tax-free, but after 75, withdrawals are taxed at probably your beneficiaries' what's called marginal rate of tax, whatever their rates of tax are, income gets added to it, so they pay tax on that. So it's not so good if you die after 75. By the way, that's not a plan to make sure you die before 75, obviously. You want to live as long as you can. Anyway, this makes pensions an incredibly useful long-term estate planning tool, in spite of the fact they become subject to inheritance tax from April 2027. Bringing the strategy together. Here's your 2025 ready wealth framework. Number 1, use your ISA allowance fully. Stocks and shares ISAs remain untouched. Number 2, use salary sacrifice appropriately, bearing in mind national insurance benefits capped from April 2029. Number 3, company directors combine salary, dividends, and employer pension contributions to take your money out of the business as tax efficiently as possible. Number 4, use your capital gains tax allowance of £3,000 per spouse annually and maximise it. Number 5, consider the carry forward rule for large legitimate pension contributions. Remember, it's £60,000 per annum per person maximum that can pay into personal pensions. Number 6, property investors. Model your net returns after the 2027 tax increases of 2%, whatever your tax rate. And number 7, use pensions as part of long-term estate planning. These are not tricks. They are the standard tools built into the UK financial system to help people like you plan responsibly for the future. Best of luck with that. Look forward to welcoming to you the next episode.